Hey everyone, this is Purti, and today I want to talk about one of the easiest ways of building your wealth, which will help you drive you towards your financial independence, that is, investing in financial markets. Now, before we talk about investing, it's really important to have the right understanding of what money is. In my previous videos, I talked about how the cash in your bank account is actually an IOU. In case you missed it, I highly encourage you to watch it, and the link is in the description below. I try to consciously remind myself of the fact that investing in an asset is not spending your money, but rather getting rid of the old debt that the government owes you. Recently, the federal government has bought treasury bills at 0.25%, also known as the federal funds rate. Or for those in India, the RBI repo rate is 4%. What that means is that for every $100 in cash that I own today, I probably will grow it by just 25 cents or just 4 rupees in a year's time, keeping it in a bank account. Do I think I can do better than this by investing in the financial markets? Definitely yes. From a broad perspective, the financial markets can be divided into 4 categories. Number 1 on the list is, which is also the most popular, is the stock market or the equities market. This is a market where you take your IOU, that is cash, and exchange it for a small share of the company, also known as stock. So you may ask, why would you do that? Well, let's hypothetically consider a company like Facebook, trading under the ticker symbol FB, and you invest about $200 to get one stock of Facebook. Facebook has thousands of employees working together to release more features and products, which in turn leads to more sales, and it in turn makes the company more valuable due to the increased demand for their products. And all of a sudden, to get the same one stock of Facebook, you may need to shell out about $220. That's like a $20 gain in your net worth with absolutely no effort of your own, but you're leveraging efforts of thousands of employees trying to make their company more valuable. Needless to say, if the company is losing its desirability, the same one stock of Facebook becomes less valuable. That's why generally investing in good companies with a solid balance sheet often leads to robust growth of your wealth over a considerable period of time. In reality, though, one must consider numerous factors such as what the market is speculating about the growth of the product segment, the growth potential for the stock, etc. At the very least, it beats keeping it at 0.25% at a rate of return from the Federal Reserve. Number 2 on the list is the less commonly known options market. The options market is a derivative market of the stock market. I would be discussing more about this in the future videos, but for now, conceptually speaking, think of options as the ability to control actions on the stock via a contract. Does it sound complicated? It really isn't. A contract typically contains information on the stock it's bound to, the type of action on the stock, that is whether you want to buy or sell, the price of trading the stock, the amount of stock it controls, the expiry date of the contract, and what is the current value of this contract. The beauty in this approach is that you don't really trade the stock, rather you trade the contract, which is the right or the promise to trade the underlying stock at the specified price as written in the contract. The contract's value increases or decreases in value depending on the movement of the underlying stock and the type of contract. Let's say, for example, in our previous Facebook stock example, available at $200 for one stock. Let's say there exists an options contract X, which is controlling 100 stocks, trading at $3. This contract increases in value as the stock increases in value. Because you control 100 stocks in the contract, Your initial investment is 3 times 100, which is about $300. Unlike if you buy 100 stocks, your initial investment would be 200 times 100, which is about $20,000. Let's say Facebook in the near future reaches about $230. Then these options contracts will be worth more, let's say by an extra $6. So it's trading at $9 now. When you get rid of these options in the market, you make a quick $600 profit over a $300 invested today. That is about a 200% rate of return. Compare that to actually buying the stock. Your rate of return would only be 3%. A word of caution, the examples I used are for illustration purposes only, and it's absolutely imperative that you understand the downsides before investing into the stock market or the options market. There are multiple parameters to consider, like the economic policy, the monetary policy, company financials, etc., before investing into the company. The options market are highly speculative markets, which can lead to significant upside or significant downside. When I personally invest via options, I always limit downside risk at the cost of my upside potential. Number 3 on the list is the Forex market. These are markets which peg the value of different currencies in the world, or in other words, it's effectively a stock market for various currencies, and it is a market where currencies are traded. To illustrate this, let's say you're living in the US and you want to travel to India for a holiday, and to pay for your accommodation in India, you need to acquire the local currency. In this case, you would have to convert the US dollar to Indian rupees, that is the INR, based on the value pegged in these markets. Equivalent value of Indian rupees are exchanged for a given value of US dollar. These markets tend to fluctuate based on the demand of a certain currency or economic policy. If there was a travel boom to India, then there would be a huge demand for Indian rupee, and theoretically you would expect the Indian rupee, that's INR, to become stronger. The strength of the currency is not just limited to travel, but for exports, imports, foreign investments, intrinsic and extrinsic demand, and speculation. These markets also tend to be speculative in nature, where you bet for or against the value of a currency, or trade a pair of currencies like the USD to the Euro pair. Number 4 on the list are the futures and commodity markets, or commonly known as the futures market. The futures market was initially developed to provide a price stability to suppliers and consumers of certain commodities. For example, think of coffee and a coffee farmer who probably takes a year to harvest coffee and wants to know if he could sell his coffee beans to a coffee bean roaster company at a fixed price for him not to incur a loss. Now, at the time of harvest, if there is an enormous supply of coffee in the market, the price of coffee will go down and the farmer would be forced to sell his harvest at a loss. To prevent this, he enters into a futures contract to sell his coffee at a predetermined price in a year's time. The consumer, that is the coffee beans roaster company, would also prefer to buy coffee beans at a fixed price so as to estimate the amount of money he would spend in the future so as to better manage his trade or better manage his business. While in earlier days actual deliveries of commodities would take place, these days contracts are exchanged, and based on the demand and supply pressure, the prices tend to find stability. Some other common commodities are gold, silver, crude oil, and sugar. To give you an understanding of how big each of these markets are, the net asset value of the US stock market is about $36 trillion. The options market is about $640 trillion and the forex market is about 2 quadrillion or $2,000 trillion. So, just as a recap, I briefly talked about 4 categories of the financial markets in which you can invest in. That is the stock market, the options market, the forex market and the futures market. If I were to start off, I would focus more heavily on the stocks and the options market. Let me know if you're interested in learning about the forex and futures market in the comments below. As always, please don't forget to leave your comments or suggestions below. My sincere hope is to help you make money. If you like this video, don't forget to like, share and subscribe and hit that bell icon for more videos on financial literacy. Thanks for joining me today and I will see you all in my next video. Bye-bye.